Hi there. This is Aditya Aluwalia from Finstructor, and we'll continue our discussion on Introduction to ESG, and we'll study about putting ESG into practice next. And all this will be covered in a lot more detail in the remaining sessions. But for an introduction, ESG investing is a strategy and practice wherein we incorporate ESG factors into the investment decisions and active ownership process. So institutional investors, that is mutual funds, insurance companies, pension funds, etc., typically reflect ESG considerations in three ways. First, they can incorporate ESG factors, environmental, social, and governance factors, into their own investment decision making. That is, which companies they choose to invest and which companies to avoid through corporate engagement and encouraging corporates to improve their ESG practices, and through policy engagement with regulators and other standard setters. So different institutions take different approaches, and that reflects their own culture and their own investment style. So again, a little more detail. First is how can they incorporate ESG factors into their own investment decision making. So for asset owners who give the mandate to different funds, who appoint fund managers to manage their assets for them. So these are the asset owners. Again, they can be pension funds, they can be individuals, they can be institutions, they can be foundations, they can be funds of any sort. So these people own assets, and then they hire fund managers, or they hire other institutions or other corporates to manage the money for them. So first, these asset owners can include ESG factors in the request for proposal and consider them in the appointment process. So they can ask each fund manager as to how they use ESG and how they incorporate ESG into their valuation or investment decision making. And then they can choose the fund managers who they are satisfied are sufficiently incorporating ESG to the fund's liking or to the asset owner's liking. They're often supported by consultants who also factors in these asset managers' ESG policy, and they can help guide them that which funds or which institutions are better at incorporating and implementing ESG in their selection process. And asset owners can also reassure themselves that their views on ESG are being implemented by integrating the views into their investment mandates and their monitoring process. That is clearly communicating to the fund managers what their views are and what they would like from an investment process. So that's just an introduction. Again, asset owners and some asset managers can embed ESG into the strategic asset allocation. So strategic asset allocation is the process that decides how capital is allocated across asset classes, like between fixed income and equity, for instance, or between alternative investments and traditional investments, between which regions or which countries, depending on the need for return and risk. So that's the first step in fund management generally. It's a strategic asset allocation. So ESG can be incorporated right there itself, and we'll study in more detail later as to how this can be done. Um, Finally, asset managers and asset owners who invest directly into stocks or directly into fixed income securities can incorporate ESG issues within their security selection process. And again, we'll study this in a lot more detail, but you can use a ratings based filter or threshold, which rules out potential investments or rules in potential investments. Similarly, you can integrate ESG issues within your financial or risk analysis, your modeling, your valuation discount, so on and so forth. Using ESG criteria to identify opportunities through a thematic approach. So if you're a specific impact investing fund or a water fund or an energy conservation fund, then you can directly look for those themes and look for those stocks that are helping that particular theme. So these are some ways how ESG can be incorporated into investment decision making. Um, it can also be incorporated through shareholder engagement. So what investors can do is that they can encourage their investee companies to improve their environmental, social, and governance practices. So they can communicate during the company's annual general meeting, which generally happens once a year, through voting on resolutions or through expressing their views in that meeting, but not necessarily. Even informally or more formally, you can meet during the year, during a quarter, or at the end of the quarter, at the end of a semi-annual disclosure, and discuss the company's views on ESG and ask them to implement more ESG friendly practices into their business. So again, we'll study more of this also later on, but shareholder engagement is another way. And finally, policy engagement is the third way that ESG investing can be done. That is, you work with regulators and standard setters and other parties to help design a financial system that is more sound and stable, levels the playing field, and brings ESG more effectively into financial decision making. So investors can help regulators and policymakers and governments too, because they also study and they are experts in some right. So they can help respond to policy consultations, participate in collective initiatives, and make recommendations to policymakers so that ESG is more effectively incorporated into the financial system and into the fund management system. In the last section about introduction to ESG, we'll take a look at some of the key initiatives taken by the United Nations and by governments and regulators across the world to promote ESG practices. So the United Nations has been a critical player in the advancement of sustainability and specifically responsible investment in the past 30 years. And three of the initiatives are of particular interest, and we'll go through those in details. So first is the United Nations Global Compact. So this is the chief amongst the supranational initiatives wherein all countries come together. So the UNGC, or the United Nations Compact, was launched in 2000 as a collaboration between leading companies and the United Nations. So it has since gained remarkable traction and now claims to be the largest CSR initiative or corporate sustainability initiative in the world, with over 8,000 corporate signatories across the globe. So again, these companies have agreed to adhere to 10 principles derived from the broader global standards. And the 10 principles cover four areas. Very importantly, if you must know, human rights, labor, environment, and anti-corruption. So there are 10 principles, and the UNGC provides investors with a helpful set of principles to assess and engage with companies, as well as directly aid the companies in becoming more sustainable. So again, the 10 principles cover these four areas of human rights, labor, environment, and anti-corruption. So it's a very, very good thing that the United Nations has done. So it provides guidelines and it provides help to both investors as well as corporates in achieving sustainability. The next is the United Nations Environmental Program Finance Initiative, so UNEP, the Finance Initiative. And this is a partnership between UNEP and the global financial sector to mobilize private sector finance for sustainable development. This started in 1992 and has co-created these three practices which are very important today also. So the first is the Principles for Responsible Investment, established in 2006 and now applied by more than half of the world's institutional investors, about 103, who manage about $103 trillion of assets. So it's become very big in recent times. Principles of Sustainable Insurance, established in 2012, applied by about one quarter of the world's insurers, and Principles for Responsible Banking, set up in April 2021, for which more than 220 banks have signed up, or more than one third of the global banking sector. So PRI is amongst the most uh, popular or the most advanced initiatives of these three, launched the first in 2006. And we'll study more about the Principles for Responsible Investment. So this comprises of an international network of investors who are signatories to this agreement, who work together towards a common goal to understand the implications of ESG in investment decision making and in investment or in ownership practices. So the PRI, or Principles for Responsible Investment, provides support in four main areas. So it provides a broad range of tools and reports on best practices for asset owners, asset managers, consultants, and data suppliers, supporting the implementation of the principles of all asset classes and providing insights into ESG issues. So again, AIM hopes to provide some tools on the best practices, number one. Second, it hosts a collaborative engagement platform by which it leads engagements and also enables like-minded institutions to coordinate and take forward engagement with individual companies and sectors on ESG related issues. So it helps the asset owners or institutions interact with the corporates on ESG related issues. The PRI reviews, analyzes, and responds to responsible investment related policies and consultations, and it provides a policy map to investors and facilitates communication between investors and the regulators on the topic of responsible investment. So again, helps engage with the companies directly and also helps the regulators and the investors engage among themselves. The PRI Academy develops, aggregates, and disseminates academic studies on responsible investment related themes. So again, a very important institution, and it has developed 6 principles, which are voluntary but provide overarching guidance on actions members can take into incorporating ESG issues into their own investment practice. So the principles are: first, we will incorporate ESG issues into investment analysis and decision-making process. We will be active owners and incorporate ESG issues into our ownership policies and practices. We will seek appropriate disclosure on ESG issues by the entities in which we invest. We will promote acceptance and implementation of the principles within the investment industry. And signatories, or as participants of the PRI, we will work together to enhance our effectiveness in implementing the principles. And we will each report on our activities and progress towards implementing the principles of PRI. So again, um, and the signatories to the PRI are growing every day, and all of them are incorporating, essentially entering into an agreement. May not be committed, it's still voluntary, but still they're showing their commitment to incorporating ESG within their investment practice. Again, PRI also leads or establishes partnerships with other organizations to develop initiatives such as a review of the fiduciary duty around the world, establishment and implementation of sustainable stock exchanges initiative, etc., so on and so forth. So again, membership of the PRI has today become a badge for being a responsible investor, and it's more and more companies, like I mentioned earlier, or more and more asset managers and fund managers are signing up with the PRI. And it does require the members to report annually on their responsible investment practices, which are then assessed by the PRI. So the report is made available to the public, and the assessment is private to the member at the moment, who can then decide whether or with whom they may want to share the assessment. So PRI will also give an assessment on how good their reporting or their incorporation of ESG issues is in their own investment practice. So again, uh, so there are no minimum requirements to become beyond the payment of the membership fees. So there was this criticism in the past. So PRI implemented minimum requirements. So now, if you're a member of the PRI, that is, you're claiming to be a responsible investor, then the policy that covers the firm's responsible investment should be greater than 50% of the assets under management. So more than 50% of your AUM should be managed in a responsible way or according to the PRI guidelines. Internal or external staff is responsible for implementing the investment policy. Senior level commitment and accountability mechanisms for responsible investment implementation. So these are now required in case you want to be a signatory or you want to be a member of the PRI. And the growth in number of PRI and signatories and the size of assets managed has been phenomenal. And just like the overall awareness and the relevance of ESG has gone up in the recent years, so has the number of signatories of PRI. And today, as of April 21, PRI asset owner signatories were about 606 in number and manage assets of over 31 trillion US dollars. So there were about 4,000 investors or asset manager institutions across the world that were signatories of the PRI. So it has had a phenomenal growth and is growing continuously, just highlighting how important ESG investing is becoming today. Another very important initiative by the United Nations is the Framework Convention on Climate Change. Um, so it has been a focus of the United Nations and more recently of everyone in the world, including investors. Climate change is a very important topic today. And the UNFCCC hosts conferences of parties. So COP is what is called conferences of parties, which seeks to advance member states' voluntary agreements on limiting climate change. And the most recent one that we had in 2021, I think it was COP26, wherein again a lot of nations made commitments to become net carbon zero or decarbonize in a very big way in the coming years. So the two COPs, Conference of Parties, in particular importance was COP3 in 1997, which created the Kyoto Protocol. Again, this commits industrialized countries to limit and reduce their greenhouse gas emissions in accordance with the agreed targets. And the COP21 was in 2015 in Paris, which led to the Paris Agreement. And this again commits developed and emerging economies to strengthen response to the threat of climate change by keeping global temperature rise in this century well below 2 degrees Celsius or 3.6 degrees Fahrenheit above the pre-industrial levels. So they want to again limit global warming. And again, COP26 is also very relevant, not included in this review, but that happened in the end of 2021, where again, a lot of commitments were made on decarbonization. So again, this is a very important institution that helps address the issue of climate change. And another important work is by the United Nations Sustainable Development Goals. So the Sustainable Development Goals agreed to by all United Nations members in 2015 are the UN's blueprint to address key global challenges related to poverty, inequality, climate change, environmental degradation, peace, and justice. So these goals are 17 goals are interconnected, and again, these are not directly applicable to businesses, but again, a lot of investors are already reporting their progress on these issues and how they're allocating capital to help these issues. So the 17 issues are no poverty, zero hunger, good health and well-being, quality education, gender equality, clean water, affordable and clean energy, decent work and economic growth, industry, innovation and infrastructure, reduced inequalities, sustainable cities and communities, responsible consumption and production, climate action, life below water, life on land, peace, justice, and strong institutions, and partnerships for the goals. So you don't have to remember them, I think exactly, but it's good to know that sustainable development goals are also on the agenda, and investors and companies are required to, or if not required to, are looking to working towards these sustainable development goals. Now, on the reporting initiatives, currently there is a lack of standardization, so there are many competing frameworks and methodologies, and they're mentioned in your in the curriculum, but we won't go through each of them in a lot of detail. So there is some issues about the integrity of ESG data because there is no standard reporting like we have in accounts or we have in general finance, like we have the accounting standards through which companies report their financial performance. In case of ESG performance and ESG data, I think it's still evolving, so there is no strict standards as yet. The Global Reporting Initiative is the biggest in the area, and it provides guidance on disclosure across environmental, social, and economic factors for everyone, including investors, corporates, and all stakeholders. And other frameworks are primarily focused on how investors should report their ESG performance or their ESG activities. So again, many organizations today use the GRI framework, which is the most well-known and is a standard for the United Nations Global Compact. So this will you will have to report on your environmental initiatives, governance initiatives, board diversity, so on and so forth, that we'll go through in more detail later on. There are other initiatives also. I will not go into the details of these, but you can go through them. So there is the Value Reporting Foundation, which again also gives some accounting standards or reporting initiatives, which gives some guidelines on how investors and corporates can report their efforts or their performance on various ESG metrics. Again, in the section on environmental, we'll study more about the Environmental Disclosure Project. So there is the former CDP, Carbon Disclosure Project. There was a Climate Disclosure Standards Board, the Corporate Reporting Dialogue, again joint project by the previous two organizations, the CDP and the CDSP. Again, the objective of all of these is better alignment of sustainability reporting frameworks to promote further integration of non-financial and financial information related to ESG. Yeah. Again, there are other initiatives. You can go through them, but I just know that reporting is still evolving on the uh, ESG front. So there are many networks also of between countries and between companies to promote sustainability. Again, the task force on climate-related financial disclosures, TCFD, will study more detail in the environmental section. And again, it urges companies to disclose data against governance, the organization's governance around climate-related risks and opportunities, the strategy, risk management, how the company identifies, assesses, and manages climate-related risks, metrics, and targets. So again, the recommendation is that these disclosures by companies are provided as a part of the mainstream financial filings. So again, TCFD wants to put climate change as a board level issue or one of the key issues for corporates. So again, we'll study more in the environmental related sections. Uh, and Yeah, so that was the first review in wherein we discussed the introduction to ESG. We will do some questions to test our understanding, and then we'll go ahead with the next reviews. So the first question is, what is ESG investing? So ESG is environmental, social, governance investing. So you have to incorporate ESG into your investment decision making. So it's an approach to managing companies. No, it's not an approach to managing companies. It is an approach to managing assets, yes, where investors acknowledge environmental, social, and economic. That's wrong. It has to be environmental, social, and governance. So managing assets where investors acknowledge the relevance of environmental, social, governance in their investment decisions. Yes, C is correct. D is in corporate engagement. No, it's not about corporate engagement. Which of the following is not an example of a social factor? Labor rights are a social factor. Local communities are a social factor. How your product impacts local communities. Product safety is also a social factor. Biodiversity is an environmental factor. Is not a social factor. So this will be the correct answer. In what sense are ESG considerations non-financial? Because they're difficult to value precisely and difficult to time. That is correct. So when a climate change will occur, or what is the exact cost of global warming is difficult to value, difficult to assess. So in that sense, they are sometimes non-financial, but they do have financial impact, but they're difficult to value. They're issues that will never turn into finance. That's wrong. They sit in a different category. They can only ever be measured qualitatively. That's not true. It's just that they're difficult to value precisely and difficult to time. Which of the following sectors will management of greenhouse gas emissions be most material? So greenhouse gases, carbon dioxide, nitrogen, sulfur, um, software recruitment, power. So power generation is generally very polluting and it produces a lot of greenhouse gases. Which of the following is not a typical method by which ESG is reflected in investment approaches? Integrating is not into investment approaches. So how is it? So generally, you will incorporate ESG by integrating it into your decision making. You can engage with the companies. You can engage with the regulators and public policy. We studied all this. Disclosing the investors' CSR activities is not a typical method by which ESG is reflected in investment approaches. The first three are the three approaches. Which of the following is not a form of ESG investment? So we studied various types of ESG investment. Uh, Valuation investment generally is not. There is no ESG which is value. All investments are focused on valuation to some extent, but ESG would be ethical investment, tobacco or some Christian investments we studied, thematic based on some theme of climate change or social impact. So all these themes are ESG types of ESG investments. Valuation is not. What are the four broad groupings of issues covered by the UN Global Compact? So we studied this. Human rights, labor, environmental, and anti-corruption are the four groupings covered by the UN Global Compact. Which of the three P's is not in the triple? So three P, remember, it's people, planet, profit. So people, planet, profit are the three P's in the triple bottom line. Principle is not a P. Again, this approach was given up, but it originally came as that it's not just profit that firms should think about. We have to think about people and planet also. Which of the following statements is true about best in class investment? So remember best in class. So we may try to replicate the benchmark. So we may have same weightings as the benchmark, but we will only pick investments that are above a particular threshold or that are good on ESG score or that are best in class in that particular sector from an ESG perspective. So it involves selecting only the companies that overcome a defined ranking hurdle, something like this. Yes, not exactly, but yeah, some this will be close. Let's check the other options also. It cannot be used. It cannot be used to maintain key characteristics such that regional and sectoral diversification. No, that's wrong. We studied that it can be. Even though you're picking the best in class, you can still keep the same weight in the different sectors. It refers to selecting companies that fall under a sustainability related theme, not necessarily. So we can be outside the theme, but we are still in the best in class within that. So we can invest in the power sector, but we will invest in the best in class companies, a company that is moving towards renewables or that is moving towards sustainability, that is reducing coal-based production, so on and so forth. So, and not necessarily falling under a sustainability theme. It refers to allocating capital that best mitigate climate change. No, that's not best in class. So yeah, first option is correct. That we can choose the same weighting as the benchmark, or we can choose any sector, but we choose the best in class from an ESG perspective. Which of the following sectors is not typically excluded by ethical faith-based investments? So tobacco is generally excluded, alcohol is excluded, controversial weapons are excluded. They're not allowed to invest in these. Technology is not excluded. So they will be the correct. The efficiency of shareholder agreement does not. Scale of ownership, yes, it will depend. The more higher ownership, the higher influence. Quality of dialogue and method used also. It's a one-on-one meeting, it's a formal communication. Whether divestment is a known possible, again, important. If you know that you can sell the security. So if the company doesn't listen to you, you will divest or you will sell the stock. Then again, he will be more likely to listen to you. Amount of security in free float doesn't matter. So again, this is free float is how much is publicly available for trading. So this is not our engagement depends on how much we own, what is the quality, and whether we will divest or not. So these are the three most important factors. In what way can ESG matters become financially material for a company and contribute to reduced risk and enhanced return? So how can ESG help financially? In increased cost and reduced efficiency is wrong. It's actually reduced cost and increased efficiency. If you incorporate ESG, it has been shown that generally these sustainability practices will reduce your costs and increase your efficiency. Decrease your externality. So externality is the cost to the environment or costs that are suffered not by the buyer or the seller, but by the society at large. Increased risk of fines. Now there will be reduced risk of fines because of externalities. Increased adaptability to sustainability. That's correct. So we studied four sustainability megatrends. So if companies move towards sustainable practices, they can benefit from these megatrends. What kind of situations does the term negative externality best describe? Situation where production of goods induces costs to others that are not reflected in the prices charged for them. Yes, this looks like correct. Let's see the other options. Situation where consumption induces benefits. No, that is not a negative that will be a positive externality. Situations where the production or consumption or product service private price equilibrium cannot reflect the true costs of that product. Yeah, this is a more exact definition. Situation where the production or consumption of a products or services private price cannot reflect the true cost that a product or service or society as a whole. That is true. So C is the more precise answer. That is, so it's not just whether the production, it is the negative externality is that the price is not completely reflecting the external costs. So that is why we have to internalize it, is what we studied. When we internalize it, then the price is adequately taxed or the price is increased so that it reflects the true cost or it incorporates the externality. So C is the correct answer. Situation where the true benefits cannot be recognized, that's not true. Negative is a cost. So C is the correct answer. Oxfam report shows richest 1% have more than double the wealth of 6.9 billion people, which is the mega trend, demographic changes and wealth inequality. So emerging markets, technological disruption, climate change are all mega trends. This highlights the mega trend of demographic changes and wealth inequality that we are seeing today. Which is the most reason why an investor would engage with policymakers? Because the consideration of ESG can contribute to the proper functioning of financial markets. That is correct. Asset owners need regulators to level the playing field in order to be able to increase their percentage of, no, they can increase their percentage of ESG investments even right now. So they do need regulators to level the playing field. But yeah, that is for the proper functioning of the financial markets. Policy consultations are mandatory, they're not mandatory. ESG investors require a sound and stable in order to make alpha. No, this is not about alpha. This is about having a proper functioning, because if all costs and all benefits are properly incorporated into the prices of securities, then the financial markets will be better reflective of the true prices or will be better functioning in general. So that was the first review on introduction to ESG, and we'll continue with the remaining sessions. So see you next time, and please study and revise. All the best.